Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamilton, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're discussing some significant economic insights shared by CIBC's Deputy Chief Economist, Benjamin Tal. According to Tal, Canada is currently experiencing what he refers to as a per capita recession. While this might sound alarming, Tal assures us that the situation is largely driven by temporary factors and that the country is poised for a strong recovery once these factors dissipate. Tal highlights the unique nature of the current economic slowdown, which is not a traditional recession, thanks to the influx of 1.2 million new residents over the past 2 years. This has led to a 3.5% increase in population growth, a stark contrast to the 0.9% average observed in other OECD countries. This rapid population growth has contributed to the current housing market shortage, but Tal believes that recent changes in immigration policy will help alleviate this issue. In Toronto, the housing market presents a mixed picture. While houses and low-rise properties have remained stable, the high-rise condo market is facing challenges. Tal points out that many condo investors are dealing with negative cash flow, which has led to a slowdown in new condo construction. However, he anticipates a significant rebound once the current inventory is absorbed, driven by continued demand and potentially lower interest rates. Adding another layer to the economic landscape, Tal discusses the impact of investment capital. With interest rates no longer as attractive, many investors who previously parked their funds in guaranteed investment certificates are now seeking new opportunities. Tal estimates that between $200 and $300 billion could be redirected into the stock market and real estate, creating a once-in-a-lifetime opportunity for growth. Interestingly, Tal also downplays fears surrounding mortgage renewals. While some economists and homeowners are concerned about a potential renewal tsunami, Tal suggests that many borrowers will actually renew at more favorable rates than previously expected. He estimates that about 40% of those renewing in 2025 will enjoy lower rates, easing some of the financial pressure on homeowners. Finally, Tal turns his attention to the interplay between Canadian and American economic policies. He emphasizes that Canadian mortgage rates are more closely tied to U.S. Treasury yields than to domestic policy decisions. This means that understanding U.S. economic policies, including those influenced by former President Donald Trump, is crucial for predicting Canadian mortgage rate trends. As more than 1 million mortgages come up for renewal in Canada this year, a new survey reveals that the majority of these homeowners anticipate an increase in their monthly borrowing costs. This survey, conducted by Hill & Knowlton for Royal LePage, indicates that 57% of Canadians who are set to renew a mortgage on their primary residence this year expect their monthly payments to rise. Of these, 22% foresee a significant increase, while 35% expect a slight rise. Meanwhile, 25% of respondents believe their payments will remain stable, and 15% actually anticipate a decrease. The survey highlights that approximately 1.2 million mortgages are due for renewal in 2025. A significant portion of these, around 85%, were initially secured when the Bank of Canada's key policy rate was at historically low levels, at or below 1% during the COVID-19 pandemic. Royal LePage President and Chief Executive Officer Phil Soper explained that while rates have been decreasing, they remain higher than those low pandemic-era levels, which is a concern for many homeowners. Among those expecting their payments to increase, a substantial 81% indicated that the rise would place financial strain on their household. To manage the increased costs, many plan to cut back on discretionary spending, such as dining out and entertainment or reduce travel expenses. Additionally, 10% of respondents are considering more drastic measures, such as downsizing, relocating to more affordable areas, or renting out part of their home. Phil Soper also noted that external economic factors, like a potential trade war with the United States and President Donald Trump's threat of imposing 25% tariffs, add to the anxiety of Canadian homeowners. However, he suggested that the Bank of Canada might respond to such economic pressures by loosening monetary policy to alleviate the burden on the economy. This could result in lower rates, potentially offsetting some of the financial challenges faced by homeowners. The survey also indicates shifting preferences among mortgage holders. While most households with pending renewals intend to keep the same type of mortgage product, there's a growing interest in variable rate mortgages. Currently, around two-thirds of those renewing plan to choose a fixed-rate loan, a decline from the three-quarters who currently hold such mortgages. In contrast, 29% are leaning towards variable-rate loans, up from the current 24%. Furthermore, 37% of respondents plan to opt for a 5-year mortgage term upon renewal, while 19% prefer a 3-year term. Soper pointed out that although Canadians typically favor 5-year fixed-rate mortgages, this choice may not always be the most logical. In periods of declining interest rates, as observed recently, locking in for a longer term might not be advantageous. He noted that while a 6-month variable rate mortgage may initially be more expensive, it could offer more affordability in the long term, as borrowers might secure lower rates later on. The Canada Mortgage and Housing Corporation, or CMHC, has released a new housing market outlook that forecasts a slowdown in housing starts through 2027. This projection comes despite a strong beginning to the year, with the total monthly seasonally adjusted annual rate for housing starts across Canada increasing by 3% in January. Actual housing starts were up 7% year over year in areas with a population of at least 10,000. The CMHC attributes this anticipated slowdown to several key factors, including lower immigration levels and evolving United States trade policies, which are contributing to economic uncertainty. Tanya Barraza Ochoa, Deputy Chief Economist at the CMHC, noted that while these increases show early signs of progress, foreign trade risks pose significant uncertainty for housing construction moving forward. The report indicates that housing starts are expected to slow starting this year and continue through 2027. However, they will remain above the 10-year average. A major factor in this slowdown is the condominium market. With low investor interest and more young families seeking family-friendly homes, developers are finding it more challenging to sell enough units to fund new projects. This increase in unsold units is likely to reduce new project launches, leading to a decline in new condominium apartment construction. In Ontario, particularly in condo-centric areas like the Greater Toronto Area, Hamilton, Kitchener, Cambridge, and Waterloo, higher interest rates have pushed down demand. This has reduced condominium apartment starts, with fewer land deals, project launches, and pre-construction sales in recent years. The situation is similar in British Columbia, where pricing, low demand, and lack of pre-sales are affecting condo construction starts. However, a stronger resale market could support planned projects. The CMHC also expects that more affordable options, such as row houses, will lead a small recovery in ground-oriented homes, including detached and semi-detached houses. Regionally, new construction in Quebec is expected to recover from recent lows, while in Alberta, new construction will slow down from high levels. Strong momentum in rental apartment construction is largely driving housing starts across the country and is expected to continue into 2025 and 2026, following a record year in 2024. Federal programs are contributing to growth in rental starts in the prairies, while a tight rental market and government initiatives in Vancouver and Victoria are spurring new developments. In Ontario, the lack of condo starts will be offset by robust purpose-built apartment rental starts, though this may cool in 2026 as developers become cautious about increasing vacancies and lack of high-rise land deals. The report also outlines 3 scenarios based on significant economic uncertainty, including reduced immigration targets and potential U.S. tariffs. In a worst-case scenario, the U.S. could impose a 25% tariff on all Canadian imports, which could have major implications for Canada's economy, including investment uncertainty, a weaker Canadian dollar, and higher inflation. In a medium growth scenario, where the U.S. imposes a 25% tariff on 10% of Canadian goods, the economic impact might be lessened by stronger U.S. government spending and higher demand for imports. Despite these economic headwinds, the CMHC expects housing market activity in Canada to improve as lower mortgage rates and changes to mortgage rules bring buyers back into the market. First-time home-buying millennials are anticipated to continue driving housing demand in large urban areas. By 2027, much of the pent-up demand is expected to be met, with improved job markets and income growth making housing more attainable than during the 2022 to 2024 period. Ontario real estate prices have shown a year of stability, according to figures released by the Canadian Real Estate Association, or CREA. In January, the average single-family home in the province sold for $960,300. This marks a 1.3% increase from the same period last year, when the average price was $947,700. It's important to note that these numbers are seasonally adjusted and do not account for inflation, which is currently running between 1.9 and 2.7%, depending on the measure used. Sean Cathcart, CREA's senior economist, pointed out that while there was a significant jump in new supply at the start of the year, there was also a noticeable weakening in sales towards the end of January. This shift coincided with U.S. President Donald Trump's threats of tariffs and even annexation, which began around his inauguration in early January. Cathcart attributed the change in demand to the uncertainty surrounding these tariffs, which, coupled with higher supply, has led to a softer pricing environment, particularly in British Columbia and Ontario. On a province-wide basis, the prices for condominiums fell by 2.5% year over year, while townhouses saw a modest increase of 0.9%. CREA Chair James Mabey commented on the situation, highlighting the threat of a trade war with the United States as a major concern. Mabey noted that while economic uncertainty and job market worries might keep some prospective buyers on the sidelines, the current softer pricing environment and lower interest rates could present opportunities for others. In terms of regional performance within Ontario, the northern parts of the province continued to exhibit strong growth. Single-family homes in Sault Ste. Marie saw a 12.1% increase year over year, and those in North Bay were up 10.1%. In contrast, the Greater Toronto Area experienced a 2.7% rise in single-family house prices, a 5.9% decrease in condo prices, and a slight 0.5% increase in townhouse prices, all based on seasonally adjusted numbers that do not account for inflation. Looking ahead, CREA anticipates a more active spring for the housing sector, despite the looming threat of a trade conflict with the United States. While some buyers may remain cautious due to economic uncertainties, others might find the softer pricing environment and reduced interest rates appealing. This dynamic could lead to increased activity in the housing market as the year progresses. The Financial Services Regulatory Authority of Ontario, known as FSRA, has taken decisive action against Monarch Mortgage Group Incorporated. On February 18, 2025, FSRA announced that it has revoked the mortgage brokerage license previously issued to Monarch and has refused to grant a mortgage broker license to Victor Pica, the former principal broker of Monarch. These decisions are grounded in the Mortgage Brokerages, Lenders and Administrators Act of 2006 and its subsequent amendments. The FSRA found that Victor Pica provided false or misleading information in his application for a mortgage broker license. Furthermore, he failed to submit necessary information to the FSRA and did not take adequate measures to ensure that Monarch complied with regulatory requirements, such as maintaining errors and omissions insurance and making the required filings. FSRA's findings suggest that Pica's past conduct raises reasonable concerns about his ability to conduct mortgage brokering activities with integrity and honesty in accordance with the Act and its regulations. As a result, FSRA determined that neither Pica nor Monarch is suitable to hold or maintain a brokerage license. Significantly, neither Monarch Mortgage Group nor Victor Pica requested a hearing to contest FSRA's proposal, which underscores the regulator's firm stance on maintaining industry standards and protecting consumers. The FSRA's enforcement actions, as highlighted in this case, are part of its broader mandate to protect consumers by ensuring compliance and integrity within Ontario's financial services sector. For those interested in further details about the FSRA's enforcement activities, the regulator maintains an accessible enforcement database. In recent news, Highclere Capital Corporation has announced the launch of a new and transformative mortgage company aimed at reshaping the Canadian mortgage industry. This new venture, led by seasoned entrepreneurs Leon Dedoon and Paul Gruel, is set to offer a wide array of dynamic mortgage products to mortgage brokers across Canada, all backed by global capital markets solutions and powered by an advanced loan origination system utilizing artificial intelligence technology. Highclere Capital is actively engaging with Canadian mortgage brokers interested in partnering with their experienced team of lending professionals. Their goal is to provide a diverse range of mortgage solutions, from competitive prime mortgage products to flexible alternative options. These offerings will be delivered through a network of reputable mortgage brokers and agents, all committed to empowering Canadian homeowners throughout their homeownership journey. The company has been founded with a strong emphasis on capital market solutions, mortgage technology, product innovation, and customer service. Highclere Capital aims to offer reliable and forward-thinking choices to its Canadian partners, even in its early stages. Leon Dedoon, the Chief Executive Officer of Highclere, highlighted that their growth strategy involves offering a variety of residential mortgage products to brokers, leveraging innovations in funding methods. Artificial intelligence and machine learning technologies will be central to Highclere's operations, ensuring that service levels and adjudication are at the forefront of the industry. This new system is designed to accelerate the advancement of qualified applications by removing common roadblocks and delays, significantly streamlining the process of securing funding. Highclere is committed to offering flexible solutions tailored to fit unique situations, helping more Canadians achieve their dream of homeownership. Highclere Capital will begin accepting client applications at the end of April 2025. Their innovative approach, leveraging technology to enhance the mortgage process, coupled with internationally sourced capital markets funding, is poised to expand mortgage product solutions at competitive rates, empowering their partners and clients with approaches that foster long-term success. For more information about Highclere Capital Corporation, interested parties can visit their website at highclere.ca. As this new player enters the market, it will be intriguing to observe how their innovative strategies and use of technology will influence the Canadian mortgage landscape.